Welcome to the Hub's 2025 election coverage. I'm Rudyard Griffiths. We thought we'd get a quick economic hit into our mental bloodstream this afternoon with Ian Lee of the Sprott School of Business, one of our favorite commentators on all things tariff and election related. Well, Ian, a crazy 24 hours, but what I want to talk to you about today is the market weakness that we're seeing, a huge explosion, obviously, to the upside yesterday on Trump's announcement of a postponement for 90 days for countries negotiating with the United States, obviously excluding China. But then today, as of the time of recording, early this afternoon, we're seeing not just the stock market down, but this disturbing trend that emerged after the Rose Garden speech where bond yields are up, so bond prices are down, and we're seeing U.S. dollar softness. What do you make of this? Why are bonds and stocks moving down together, and what does that say to you?
Markets hate uncertainty. As you know, Rudyard, maybe some of your viewers don't know, but I was a banker, one of those bad bankers, for 9 years before I went back from my master's and my PhD and became a professor. I didn't even become a professor until my mid-late 30s because I've been 10 years in banking, lending millions of dollars to small and medium-sized enterprise and high net worth individuals. And of course, when you're in that kind of a situation, I was with Bank of Montreal, they trained the dickens out of you. And of course, we were told, you had to read the newspaper every day. We had Globe and Mail delivered to each of our desks, and we studied the markets all the time, every day. And that's where I acquired that habit. And, you know, when you do that, I'm going to answer your question. You learn to distinguish between, call it the ephemera of the variability, you know, minute by minute, the day traders focus on, which I don't focus on as somebody who teaches strategy, versus the longer term fundamentals. Not to suggest that those gyrations are not accurate. I'm not trying to call into question the validity of the market. I believe that markets price at a moment in time. They're pricing with all of the best information that's available. And that makes it very dynamic because there's always fresh information crashing across all the investors and the buyers' desks. So I think what this is showing is the incredible, remarkable uncertainty that has been created by the Trump White House on the tariffs. And I don't want to just say, oh, tariffs, you know, and I'm completely opposed to tariffs, have been all my life, but I'm not trying to suggest that, you know, you announce a tariff and that's just it, the whole market tanks. It's not so much the tariffs per se, as it's the constant changing of the decision about the tariffs.
Right.
I mean, they change by the hour, by the day. And markets don't like that. Companies don't like that because it makes it very, very difficult to plan. And in most industries, they're very capital intensive. And when you're talking putting out, you know, $5 billion for a new plant, an auto production plant, or $1 billion to develop a new pharmaceutical product, you know, you need, there's nothing, you know, the future is unknowable for sure, but you still need some confidence and certainty that it's going to look something like it does today and last week. And when you have this kind of uncertainty that is, and investors understand it affects the interest rates, it affects consumer confidence, business confidence, investor decisions. It affects currencies. I mean, this is one of those things that it's affecting almost all of the macroeconomic variables.
Yeah.
So I'm not shocked by this incredible variability.
Yeah. Ian, let's take a look at the all-important Canadian 5-year government bond. This is the bond that sets basically all of our mortgage costs and rates. And you can see that since that Rose Garden announcement, even though the Canadian economy prior to the announcement going into this spring has been very weak, and the Bank of Canada has been cutting rates and bond prices were heading up because yields were coming down, we're now seeing the reverse. And I mean, this is painful for a Canadian economy where we have very poor growth prospects, where we may already be in recession. But that now we're seeing our single most important, basically, price of capital. It affects, you know, our multi-trillion-dollar real estate industry. It's going up. It's heading in the wrong direction. largely, Ian, I would think because of inflation risks from these tariffs. But again, does this concern you that we are seeing, some action here in the bond markets that is maybe telegraphing stagflation?
I agree. Again, and I lived through stagflation. I just didn't learn it from a textbook. Not criticizing anybody who does. I lived through it in the '70s during the Pierre Trudeau administration, and to be fair, the American economy too went through a decade of stagflation, and it's not nice. It's lots of inflation and no growth. Crazy as that sounds, and I think that the markets in these bond yields are factoring in a recognition that there's going to be inflation's going to go back up, and not only because of the tariffs, certainly partly because of the tariffs, but the tariffs in turn are probably going to trigger a recession. That will drive up unemployment. That will drive down GDP growth. So it has a whole bunch of negatives, and the net effect is it's going to make the running of businesses more expensive. The cost of capital is going to go up for those reasons, and so this is something that's much more troubling because the tariffs, as we've seen from Mr. Trump, can be reversed quite quickly. They're very dynamic. Whereas when the interest rates, the cost of capital gets baked in, and you start building plants or making decisions
Right.
on that, it becomes baked into those particular investment decisions, and so it can embed, and then we can see what we saw. As I said, we lived through an entire decade of stagflation. No matter what governments were doing, it just didn't seem to bring down inflation until we finally went to 20% and we murdered inflation.
Yeah.
And it was a very tough time.
Yeah. The big news of the last 24 hours has been that the tariffs on China will remain. The president today, clarifying that the new tariff rate for China is now close to 150%. I'm struggling a bit, Ian, to understand two things. One, that the big story of economics of the last quarter century or more has been this thing that we call Chimerica, the extent to which the two largest economies in the world entered into this symbiotic relationship with each other, where one of them wanted to consume what the other one was making. It paid them a whole bunch of money for all that stuff that they made, and the person who made all this stuff bought the treasury bonds, the debt of the people who were buying all this stuff. It was incredibly self-reinforcing, and it was pretty important to America enjoying lower borrowing costs, to China enjoying an explosion in growth, bringing hundreds of millions of people out of abject poverty into what is now the world's most powerful and preeminent manufacturing economy. It's hard to imagine, Ian, all that kind of getting blown up and going away, isn't it?
It is. This is an area that fascinates me, and I don't pretend to be my area of expertise, although I certainly read an enormous amount because it feeds back into courses like strategic management, where you're analyzing the competitiveness of a company. But it seems to me that what we're witnessing is an unprecedented, Herculean, Star Wars almost struggle over who's going to run the 21st century, who's going to dominate, who's going to be the world superpower, not a bipolar system where they sort of share the world. I think this is it's not just about tariffs, it's not just about manufacturing and all the plastic stuff and container dishes and stuff we see at Walmart on the shelves, or Canadian Tire or Home Depot. I actually think it's about world dominance. And I've certainly read a lot of what the Chinese leader thinks, because I've been teaching there every year since 1997, and I'm fascinated by him and the policy he's setting out. And I've read a lot of what Trump is saying, and I think, and certainly the foreign. One more thing quickly, Rudyard, because I think a lot of people, certainly Canadians I talk to all the time, think that this is all about Trump. Is just this unique one person who has developed this idea, hostility towards China. if one reads foreign policy, the two digital journals coming out of Washington every year, Foreign Policy and Foreign Affairs, both parties, retired senior cabinet ministers, retired four-star generals, and that the elite decision making, it has gone very negative on China for, I'd say, going back 5, 10 years. And there is, I think, a consensus in Washington that China is the #1 threat to the United States. And this did not arise last November when Trump was elected. I'm not trying to suggest that all those people, former Obama types, are becoming supporters of Trump. I'm not suggesting that at all, because they're certainly disagreeing over the tactics, and what he's doing with strategy. But I think the larger issue when we step back is there's this galactic struggle between these two countries over who's going to dominate the 21st century. It's not just about tariffs. And so that consensus that was a very good point. The consensus that was there for the first couple of decades, Shamerica, they said, look, you make all the stuff we need cheaply to fill up the stores of Walmart and dollar stores and so forth, and you can buy our T-bills and we're going to be all happy. That consensus came to an end as more and more people in the foreign policy and military and intelligence communities manifested in all these articles I read in Foreign Affairs and Foreign Policy in the New York Times. Increasingly, we're saying China is a threat to the United States. And so that's what I think we're really witnessing. It's not just about tariffs on this product or that product.
So final question then, Ian, and I agree with that analysis. I think this is, in a sense, a moment in the last week, a historic moment where America and China have kind of taken off the gloves. They've said, okay, we're going to stop dancing around the ring, and we're going to start throwing some punches at each other. And I guess what I am concerned about is, as you say, the uncertainty you've talked about that creates, but the fact, Ian, possibly that means that this trade war between China and the United States is not something that's going to be solved quickly. That if America is going to use this trade war as, in a sense, the opening salvo of a concerted campaign now to openly and explicitly stop China's rise to global superpower status, either in a true peer fashion to the United States or even exceeding the United States, then, Ian, don't you think that there's a risk here, maybe not fully priced in here, that we could be witnessing the opening chapter of a non-kinetic war, an economic war, that just like the war in Ukraine or any other war in history, much easier to start, Ian, than they are to finish?
You're right. Absolutely right. I want to slightly disagree with you in this sense. I mean, I lived through, I came of age during the, well, not the Cold War. I don't want to say that because that started in the 50s, actually, right after the war. Winston Churchill said the Iron Curtain speech. But my father was in the military, and I have memories of the Cuban Missile Crisis. I was only 6, 7 years old, but I was old enough to remember, and my father talked about it endlessly. And where I'm going with this is we had a two-block world from the end of the Second World War until the collapse of the Soviet Union. The Warsaw Pact was not only the Soviet Union, but all the satellites, and they had their own economic system.
That's right.
And then there was the NATO bloc, which was all the Western allies. Mm-hmm. I think we could see something. It's not, history never repeats itself identically, but I could see something like that emerging. And when you look at the trade flows, because I'm constantly looking at data to look for the evidence, the Western bloc or the OECD bloc or the high-income nation, whatever word we want to use, they still dominate the world. The reason that the U.S. dollar is still the reserve currency is because they account for about 2/3 of foreign exchange transactions. And so China is certainly pushing in, for sure. It's trying to encroach into those areas where historically the U.S. was dominant. But, if you look at the core of the bloc, North America and Europe and Japan and South Korea, I mean, the GDP of those countries, I always use that as a proxy, is about 70%. So China is still in, and its famous BRIC supporters, they're still not anywhere near as powerful yet. And so what we could see is a re-emergence of that two-block system and that's all the more reason why I think it's important that Canada come to an agreement after the election, establish us and Europe, the allies of the United States, because the idea that we're going to ally with China or the BRIC countries, I just think is preposterous. It's beyond imagination. So much as it may be odious to many people to ally with the States because of Trump, I don't think we have a credible alternative.
Yeah. Ian, always fascinating to unpack these big geopolitical, geostrategic, geoeconomic moves with you. Ian Lee from the Sprott School of Business, thank you so much for coming on the program today.
Thanks very much, Rudyard. This is really fascinating stuff.
We'll talk again soon.
Thank you.